Good afternoon. Great to have everybody with us. Our next presenter is Tamarack Valley Energy. We have Brian Schmidt, who's the President and Chief Executive Officer, a professional engineer, and founder of Tamarack. Brian has over 39 years of oil and gas experience. And we have Steve Bytels. He is the Vice President of Finance and Chief Financial Officer. Steve brings 13 years of oil and gas, capital markets, finance, and advisory experience, having most recently served as managing director and co-head of international energy equities at Stifel First Energy. Great to have you guys with us today. Really happy that you're able to join us at the Oil and Gas Conference, and I will let you take it away on your presentation.
Thank you so much for that introduction. We're very pleased to come to Intercom, one of my favorite conferences of the year. It's really too bad we couldn't be there in person, but we're going to find a way to get our message to you through this. Intercom, we've had a long relationship with. I think we've been coming down there for probably 8 years, so we're very excited to be a part of your conference, and thank you very much. I think a few introductions. First of all, I want you next slide down, please. Normal disclaimers there on some of the information. Maybe about the future or may not turn out the way I say here today. Let's just hold on that slide, please. Thank you. So first of all, I want to introduce myself. Brian Schmidt, President and CEO of Tamarack Valley Energy. I have Steve Bytels with me. I have about a lot of experience through Shell and used to run Apache Canada. And Steve, before he starts, I'll get him to say a little bit more about himself if he wanted. But since we were last down there, Steve joined the company, and we're very excited to have him. And I think he brings a whole new dynamic and value proposition to the company. So I'm real glad to have Steve. One of the things that I think we in the oil industry have had to get a handle on is making sure that we deliver a profitable business. And it's not. We're not going to be compared to other oil companies as much as we are in a generalist fund being compared to other sectors. And that means that you really need to focus on full cycle rate of return and free cash flow. And so Steve, in particular, is going to talk to you a bit about free cash flow today and about what oil price we become cash flow positive. And I will tell you that this is a much stronger entity than what you've seen us present in other presentations. Next slide, please. I think one of the things that I'll tell you today is put your money where your mouth is, and the executive team and some of the directors. If you look up the numbers that we filed on SETI, we've purchased about $1.5 million. We put down about $1.5 million cash of our own money in the last month. So I think that goes well to those viewers of this presentation that we believe in the company and where it's headed. The last thing I'll mention before turning it over to Steve is that last year I was all excited about a water flood, and I described to you that we invested money and a few months later it was going to bring us some production, and I think we showed a little bit of production. I think it was about 100 barrels a day of water flood recovered oil. And we've hit a peak now of 1,800 barrels a day. So I'm real excited to talk to the people at the Intercom conference and show you how that has turned out and how much of a part of that future that is going to be. After Steve gets through some of these slides too, I'm going to verbally tell you about an exciting play that we have. I'm not going to say too much about it because there's land still to acquire in the play, but I do want the Intercom viewers to know a little bit about what we're up to there. So with that, I'll turn it over to you, Steve, and you can take it.
Yeah, thanks, Brian. Thanks for the introduction as well, and to Intercom. My name's Steve Bytels, VP Finance and CFO. I joined the company actually on March 16th, just as the COVID-19 pandemic was in full force, and we shut the office down, I think, 4 days later, and we're working from home. But and as Brian alluded to, in the intro, I spent the majority of my career on the capital market side of the business, advising and working with various E&P and OFS teams, both actually up here in Canada and down in the US and internationally. When we look at Tamarack here, 2020 obviously has been a challenging year, but when, as a company, there's a few hallmarks that we focus on, and one of them is our balance sheet. We maintained a strong balance sheet through all of the volatility and see ourselves exiting at less than 1.5 times debt to cash flow for 2020. As you can see here on slide 4, we do see generating free cash. At the time of the guidance here, strip was a little bit lower. I think we'd be a little bit above that $20 million range here for 2020. And the next question then is, what do you do with that free cash? We have a strong balance sheet. We really are turning our focus to being opportunistic in capturing, other value add opportunities, with respect to M&A and so forth. So, I think we look at, the fact that we came into the cycle strong, and, with what's gone on with respect to, others, having balance sheet issues and so forth, we look to obviously hopefully capitalize on that as a company. We had our bank line redetermined to $275 million in June. We exited Q2 at about 76% drawn on that. And, on our forecast here, we would see ourselves, in the $180 to $190 million range by year end. So lots of ample capacity from a lending ability. The other thing I would draw your attention to is our 2021 estimated corporate decline rate. This is really a big transition year for us with our water flood that Brian will speak to shortly, really starting to bear fruit. Along with the reduced capital program, we've seen our corporate decline. We entered the year here, in and around 38%. We'll exit the year, right around 30%, and then through 2021, drive that down to that 22 to 24%. Which really is going to help enhance our overall sustainability moving forward. Next slide, please. When we look at the Tamarack, advantage, really, again, as COVID-19 hit, we took aggressive and decisive action to cut our capital program and to cut costs. I think this all came through in the quarter. We only spent about $6 million in capital. And, we saw some significant savings on both an OPEX and G&A side. We expect more savings on the G&A side to come through with respect to the wage subsidy up here that we didn't take in Q2. We'll take all that here in Q3. And, continue on the OPEX side, we'll continue to drive cost and focus on making sure we're, with respect to workovers and so forth, they're meeting our economic hurdles as the price recovers. We have a strong hedge book, which I'll get to, and risk management initiatives to make sure we protect, that maintenance capital as we look forward into 2021 to ensure we're capturing as much in shareholder value as we can. And finally, we're going to get to our ESG and our Indigenous relationships with which I think sets us apart as a company going forward. Next slide. So with respect to ESG, not that I want to glance over the details here. What I would say, we are going to roll out our inaugural ESG strategy, and with that will be a report in the fall. So, that's something we'll have for all of you coming in short order. The next slide would focus on, one of the things that sets us apart is our partnership with the Kainai First Nation in Southern Alberta, which is on this new emerging Banff light oil play that Brian's going to talk to you all about. Again, here, this isn't just about, bringing them in. They're a true partner. We use qualified First Nations businesses and employees in our operations where we can, and we really are trying to promote and preserve the culture of the Confederacy through, education, film, and elder interviews. And, Brian is an honorary chief of the Blood Reserve, and it's something that, extends beyond that, that First Nation. It actually is with, respect to all of the First Nations in Western Canada and helping them move forward with respect to the development of resource on their lands. Next slide. Here is just a quick sensitivity for 2020 with respect to oil price. And again, we're a little bit north of $40 WTI here, but you can see with the numbers, we'd be north of 20 million of free cash. You can see our balance sheet there was about 1.5 times at 40. We'd be less than that now. And you can see the assumptions we were using there at the top. It's safe to say gas prices have been quite a bit stronger. So, the numbers here are slightly lower than what we're realizing today. Next slide. Slide 9 here, the chart I would draw your attention to is on the right-hand side, which really looks at the minimum oil price to sustain production. And we look at that as our stay flat production. You can see, last year we would have been about $52 WTI. With the reduction in capital this year and the obviously emergence of the water flood, we've been able to drop this to about $40 WTI. And then as we move into 2021, again, with that water flood bearing fruit and that lower decline, we see that at about $37 WTI. And that would rank as one of the top here for sure north of the border, for us. And you're going to see how that, how we relate that break-even price in terms of staying flat to our hedging policy and our hedging mandate going forward. With that, I'll turn it back over to Brian here to speak a little bit about 2021 scenario and so forth. Thanks.
So just to comment on Steve's last slide, when you compare us to a number of companies in town, that break-even oil price is very low. So I think it's a real, and you can see year on year we've been moving that down, and that primarily is driven by a lot of water flood, which I'll get into in a minute. But we're very proud that you get into the high 30s and you start generating free cash flow. And one of the reasons that that's coming along so well is we incent our staff on full cycle rate of return. And if you do that properly and calculate your returns, and when I say full cycle rate of return, I mean all in. Land, seismic, G&A, all your abandonment costs need to be carried by the drilling program and show double digits, say low 20s, full cycle rate of return. And if you do that repeatedly, that's going to get reflected in low generation of free cash flow at low prices. So I think this is one I'm particularly proud of, and stack us up against anybody. We're going to do real well there. Next, please. So one of the things that Steve and I wanted to communicate is how do you, when the company transforms itself so significantly in changing declines. So last year at the presentation, I would have said we were around 36% decline. Now we're 22 to 24. That really aids in the sustainability of the company. And you can see here, if you go back to 2020, you can see that your base decline is and you add your water flood in. Yeah, you got a fairly high base decline, but you can see with that water flood wedge layering onto the base, we're almost flat when you look at that. And then you layer in a few primary wells you did in 2020, and you really don't have much decline anymore. And that is significantly pulling down the amount of capital it stays to stay flat. So we used to be about 160 million Canadian dollars to stay flat. That dropped to about 110. And now that's dropped to probably in around the 85 to 90 million dollars for that 2021 wedge. That's a significant change. And we think that probably that next year we'll have a lot of positive cash flow. And it mainly is due to the investments we're doing in the water flood this year. And so it's a pretty significant change. And we want to make sure that our shareholders and potential investors can come to grips with that. Next slide, please. In terms of the hedging, you can see our hedges there. We're very fortunate in that a good part of this year we're in well over $50 WTI price. We've layered in some hedges in Q1, Q2 at the 40, and you can see some collars coming in at the 40 to 50, 25. So if your break-even oil price is $36 to $38, guess what? You're making money at the low point of that collar, and you're keeping the upside for your shareholders. So we're very happy to put in some hedges like that, and you can see we'll probably be putting in some more for the rest of the year. Those of you who want to know what the price is discount for the differentials. You're seeing that we're locking in here some next year at the $6.13, $6.50. So that's some of the lower differentials we saw. All our oil is light oil, so you don't see any huge discounts below that. Next. So I want to spend a minute on water flood, and there's a few questions actually came up already on water flood. And you know, water flood has had a bad rap over the last little while because guys tried to do water floods in super tight reservoirs. It never really works very well. You can't get the water in fast enough, and then you get frustrated, and then you run that thing right up to frac pressure, and then you start fracking and you lose your sweep. So it hasn't worked very well, and it took a long time for the investment community to come to grips with the performance that we're getting here. But you can see here we've got demonstrated actual performances doing real well. Last year at this time, I would have talked about 130 barrels a day. And you can see here we hit a peak of 1,600 barrels a day before some shutdowns and some injection conversions. And now we're a little over 1,000. And we're going to be 2,000 here by year end. And with our investment wedge, we'll spend about $38 million on water flood this year. And you can see here the nice ramp up we're going to get next year because of it. So all of this chart is by the end of the year, we're not spending any more money on the water flood on these to get these wedges. Basically, that's all based on the last 2 years investment. You can see I get lots of questions. Well, these things, once you get water breakthrough, they're going to roll over. No, you don't see that. You can see a nice ramp up in this solid green here up to 2021. And then you can see we're going to have a flattening off here. We're not seeing material water breakthrough. And then after that, I would say you're going to probably in 2022, that dark green is going to go to maybe an 8% decline. So this is a real nice bank of production that you're building up. In fact, if you look at this dip here in June of this year, we actually shut a bunch of wells in to get caught up on VRR so that we can move that production into 2021 when we're going to get more bang for the buck in terms of pricing. So it's built, we've got a lot of flexibility. Now, how do we know that wedge is coming? If you look at the top right, we know that you're not going to get oil out till you get water in. And you can see that we've taken the injection rate from about 12,000 barrels a day in this field up to about 25,000 here of what we're forecasting. We're about 24,000 right now. So double the injection. Yeah, we expect to get good response next year. Next slide, please. How big and how material is the water flood to us? This chart depicts that. I guess first thing I want to draw your attention to is that the blue areas that you see on the water flood, those are areas we invested in last year, and they're currently just 4 sections of land is producing over 1,000 barrels a day now on that, and continuing to grow. So we're very pleased at the performance we're getting there. We're only about 25% developed on the water flood by the end of this year, so there's lots of running room. 17 out of 52 patterns total. If you look at the barrel there's about 1 billion barrels of oil in place in this field. And all of that is amenable to water flooding. We're saying we're only going to get a modest 10.5% recovery due to water flood, which is, for most water flood guys who got experience, that's a pretty low number. So they're not overstepping our what we expect out of it. Well, 10.5%, that's over 100 million barrels of reserves we expect out of this. And if you look at our total reserve report last year was about 105 million barrels. So, and that was BOEs, not barrels. So we're actually we're able to double our reserves here with this field and what we're going to be able to do with it. So I think I'm very excited about that. So the other thing that I did want to talk to you about, we don't have slides on it, but I do want to speak to you about another play that we've got. It's in the Banff zone. It is in southern Alberta. It's joint partnership with the Blood Tribe, and they are a full paying partner. They're not. There's no promote to them. They're investing their money right alongside ours. It is a large fractured oil pool. We've assembled about 225 sections. We've got a little bit of land left to go. We drilled a well in the first quarter. and 2 wells in the first quarter, and we just fracked the second one here. And so we are getting flow results. I'm very excited about the play. We picked up a little bit more land here last week, and we've got a little bit more land to pick up. Now, these are bigger wells. You're talking in around, once we get our run rate going and we're pad drilling, they're about the $6 million Canadian. And we think that this is going to outperform most Montney plays, most Duvernay plays you see in Canada. So we're very excited about the potential. I know there's none of this built in the stock, and we'll probably put out some well results probably in the November timeframe. And so this is a huge project, probably over $2 billion in capital we can spend on this project if these wells come in successful. There's not a lot of reservoir uncertainty here. The reservoir is quite well defined. There was wells drilled in here 10 years ago, and we're using modern technology to more fracs, longer laterals to get the economics to perform. So this is mainly a cost game. There's not, so I'm very excited about that play. Next slide, please. So in summary, I think compare us to a lot of companies. I know 1.5 times debt to cash flow in the US is a very strong balance sheet. And even amongst Canadian peers, you know, a lot of guys are in the 4 to 5. I think there's only one, maybe 2 other companies with a balance sheet as clean as that. Operational execution, you can see how well we work at generating free cash flow. And Steve talked a little bit about that. Discipline on capital allocation. When you tie someone's bonus to rate of return, you usually do very well with that. Learned that at Apache, and Cimarex is a good analog for us there in the US. We do focus similar to those companies on full cycle rate of return. And we've been focused on changing corporate decline, and huge step change, 11% change on decline rates this year, I think is really going to drive the sustainability of the company. With that, I'd like to open it up for questions, please.
Thanks, guys. Great presentation. I'll kick it off with a question we have here. How did Tamarack Valley approach dealing with the COVID-19 pandemic, and what has changed since that, since the pandemic?
Yeah, good question. And I think that, I know in Calgary, you really didn't know how that was going to affect you. We didn't know infection rates. We didn't know. And so we probably went overboard managing risk there. We put protocols in the office first. We put travel freezes in first. We quarantined people from coming if they were vacationing in other countries. We quarantined people first. So we were one of the early movers in setting ourselves up for COVID, just because we really didn't know how this was going to turn out. Things like field travel, stop that. We stopped operators meeting in the office. They just stayed in the trucks and moved around. So we were probably one of the more secure ones here. And I think now we just got back in the office in July. I would tell you that the working online and went much better than I had thought it would. But you know what? It's good to have everybody back in the office too. So we have some pretty strict protocols in place here in the office on risk management, and so I think so far so good. We'll see what happens when kids go back to school and that changes, but so far so good.
Yeah, and this question looks like it might be coming in from an engineer. It says, how are you forecasting the effectiveness of your injections in the horizontal wells? Trying to kind of synthesize this a little bit. And how does that affect your expected recovery? If that, hopefully that makes sense. I know you're an engineer there, Brian.
Yeah. So what you're looking for in the there's 2 important things that you need to measure the performance of a water flood. Number 1, how fast are you getting the water in? And a lot of tight reservoirs, they never get economics because you can't get the water in fast enough. And so engineers would typically look at voidage replacement ratios. How much are you putting in relative to you taking out? And we start our voidage replacement ratios somewhere around 6 or 7. So we're hitting it pretty hard. Because the fluid is not very compressible, there's not very much gas in the system, and because you have good permeabilities, that you pick that reservoir pressure up real quick and you get a good response. So typically water floods are waiting 2 years to get response. We're waiting probably 8 months. Huge impact on the economics. And you'd say, for the individual asked the question, why does this water flood work so well? You know, we're taking wells that you drill on primary and they start off at 30 barrels a day and they come on 6 months later, respond 6 months later, and they peak out at about 170 barrels a day. And for most water flood engineers, you never really pick a peak higher than your primary. And the reason this is we're starting off with a low pressure, high perm, high oil content reservoir, and the water just works like a piston, and because it's not compressible, you get a good response very soon. In terms of monitoring, you want to make sure that second thing, the sweep, getting water in is the first thing. Second thing is that water streaking to your producer and watering it out. And because we've had some on now for a year and a half, we're not seeing that kind of thing.
Okay, thank you. Great answer. What do you see as the biggest strength for Tamarack Valley? Is it the balance sheet? Is it decline? Is it your sustainability? Or is it all those things combined?
Well, I think I'm gonna talk a couple of different aspects, and you have to get the combination of these things right. First of all, a lot of these guys are that are here on the technical side are ex-Apache, and they're used to working in that high rate of return, used to evaluating plays. I mean, my capital budget in Canada was about 1.6 billion a year. So there really wasn't anywhere in Western Canada that you didn't touch, that you had a good handle as to what worked, what didn't. So I'd say the technical guys, their ability to get into dirt that is high rate of return and makes your company sustainable is really important. And then I'll give the business side compliments too. I think that bringing Steve in and making sure that balance sheet is under control at all times, making sure you understand your risk profile, and you can see here the way we manage risk in the downturn, being highly low, great balance sheet and highly hedged, has really helped us a lot. And that puts us in a position for a lot of some M&A work as well.
Kind of combining some questions all together here. As you see prices firm in West Texas, how do you see your plans change in terms of your capital spend and production?
Well, I think let's just take ourselves in the long term. I think if you're going to be successful, we need to make sure they're outperforming companies, not only in our sector, but other sectors as well. And so I think the old metrics of the way you used to manage companies are probably out the window, and you need to compare yourselves to a pharmaceutical company or whatever, and show the shareholder that you've got good long-term free cash flow generation. And I don't think people are as particular about what you do with it. They just want to make sure that you deliver. And that's the hard part, getting yourself into the right place, de-risking capital appropriately and plays appropriately. Once you demonstrate that, then you can decide on the appropriate combination of, last time when I was down, you guys, we were buying back our shares. Do you go to a dividend? Do you do acquisitions? Do you switch to a dividend company? And so I think that we're in good shape to show long-term, a little bit of growth, a little bit of either share buybacks or dividends.
I'll come back to acquisitions, mergers and acquisitions, but question is, what part of your asset portfolio will be prioritized for capital for the rest of this year? So and into 2021. where are you going to allocate that capital?
So we spent $38 million out of our budget on water flood this year, out of a budget of about 100. We think we're going to be in around the same amount next year, maybe slightly less, but a larger percentage of our capital be spent on water flood. And why would we do that? Well, when we did, it's kind of interesting because we were looking at shutting in production. We did variable cost analysis, and you wouldn't shut that oil field in until you got down to $4. That is high netback area. And if you look at our finding cost in there, when we do water floods, you're somewhere in the $8 a barrel finding cost. So that is by far, that's tremendously economic. And that's the only thing that we're spending money on from now to year end. We've got about $6 million that we're going to put, and we're one of the few drillers really in the basin that's doing anything. So, and the reason we look at that water flood is because the money we put in now will come out next year in terms of production, when hopefully we got some good price recovery.
And this might be a great question for Steve. And how does the relationship between the Canadian and U.S. dollar impact or help your operation and financing?
Yeah, great question. Obviously on the oil side, we're getting paid in U.S. dollars there. So, for us, the weaker Canadian dollar does go a long way. And, when we look at, even our hedging plan, when we're trying to understand, where we're going to see prices for next year, we try to capture some of that delta by taking advantage of the currency. And, if you look back at that hedging slide that we had, when the Canadian dollar really weakened back in March and April, we were able to lock in some of that for next year relative to US dollar to hopefully capture some of the delta then, as oil prices recover and the Canadian dollar strengthens. So, obviously we don't mind seeing a weaker dollar for sure. And then, obviously on the cost side up here, our costs are on a Canadian dollar basis. So that is a nice, obviously, delta for us to have.
Okay. And it looks like we have time for a couple more questions. How is Tamarack Valley approaching mergers and acquisitions? What do you think the landscape's going to look like kind of rolling into 2021?
Yeah, that's a good question. And I think you probably have this attachment in your appendix. We just announced an acquisition in early July. Not a big acquisition, but it was, there hadn't been a lot of M&A activity up to that point. We paid the total approved was 60 cents a barrel Canadian. It was just 2,500 barrels a day, 4.25 million. And, just, we do those kinds of things, all the time we could. And I think that's an important question because when you're trying to look at capital allocation, I think what we'll do is pour a plan with the drilling component, but we'll quickly back off and do M&A. That's quite a bit cheaper than drilling right now. So if we can find the right thing, certainly like this did, it was just the metrics on this are phenomenal. We were paying $1,700 per flowing barrel. And if you're drilling per 17 or 18,000, well, 10 times, well, guess what you're going to do. Now, I don't expect to find deals like as good as that. However, I think the M&A activity in the fall was going to pick up. There's a number of my peers are getting a lot of pressure on their balance sheet. The banks are controlling some of the levers. And from what I hear from banks, they're fighting for mandates now, and there's a lot of activity coming in. So I think there will be some activity. I don't see us issuing a bunch of equity with our stock price where it's at right now. But I do see us using some of the balance sheet strength to pull in some acquisitions just like we had here recently.
Real quick question on takeaway and pipelines. How do you guys feel in terms of comfort, your ability to get your product to market?
Yeah, it's a good question. And last year, I probably would have been sweating that question a little bit because things in Canada were pretty tight. But when you look at the takeaway capacity, if everything gets built the way it's planned to get built, then I think we're going to be in pretty good shape. So you've got Trans Mountain that's being constructed right now. That's at 850,000 barrels. I think they're looking at how they can actually expand that right off the hop. You're looking at line 3 Enbridge, that is being expanded as well. And then you're looking at Keystone XL, which so far is under construction. You're probably aware that our provincial government took a stake in that pipeline. And depending on, you know, where the Democrats land on that pipeline, that's probably the biggest wild card there. Is that thing going to get stopped? Our hope is, and I think it's beyond a hope. I think there's so much pipe in the ground on that thing. And by the time, if there is a change in government there, it's pretty hard to stop it at that point.
Okay. Last question that I think we have time for. You mentioned the ESG report, corporate social responsibility report in some form coming out this fall. What should we expect to see in that? And is it kind of creating the baseline for your strategy that you're going to be executing on in the next coming years?
So there's two things. When I look at other ESG reports, I was always frustrated because these third parties come in and I get a crappy score, and it's largely because we haven't put out the information in a form that they can understand. But quite simply stated, light oil will always be better than oil sands oil on a GHG, and those guys have great scores because they show improvement. Well, my starting point is way better, so we plan on showing the GHGs per barrel that we're currently using in our fresh water per barrel. We're using produced water for our fracs right now. We're not using fresh water, so in the veteran area. So there's a lot of good news stories where we're already at a point where our numbers look a lot better than our peers. Point one. Point two, we can show in the last few years how we're making ourselves even better than that. So you know, I think that, and then when you look at the S part, myself as an honorary chief and what we're doing for First Nations, we should be able to, I just think I told the guys, there's no reason we can't have the top ESG performance score in the basin. I probably won't accept it if there's anything different there, because I know when you add up the things we're doing, it's pretty impressive.
Well, kudos to you guys. I appreciate you guys coming on and sharing Tamarack Valley. Brian Schmidt, Steve Bytels, certainly available for one-on-ones. You still have time today and tomorrow. If people want to register, schedule a one-on-one with you. You bet. Tomorrow is probably better. Yeah. Okay, great. So I want to encourage everybody. You got a lot of viewers on right now. So if you need to follow up and have a conversation with these guys, please schedule that one-on-one on the Oil and Gas Conference website. We appreciate your time. Thank you guys for sharing, and thank you guys for participating. Thank you.
Thank you.